welcome to Griffonomics.
Glad to be here for this one. It's definitely a wild situation.
Oh, it really is. So I want you to imagine a scenario. Imagine a company announces they just completely crush their earnings estimates.
Right, like a solid beat across the board.
Not just solid, I mean, not by a little margin, but a massive 205% beat on their earnings per share.
Which is just, I mean, you almost never see that kind of outperformance.
Exactly. And then, in the exact same breath, they announced this record-breaking pile of new contracts, like the kind of backlog that practically guarantees revenue for years.
Yeah, full visibility into the future.
Right. And just to put a cherry on top of all this, they confirmed they are aggressively expanding into, arguably, the single hottest sector on the planet right now.
You're talking about artificial intelligence data centers, of course.
Yep, AI data centers. So if you were reading that morning financial feed, sipping your coffee, you were probably expecting this stock to just open up 20, maybe 30%.
Oh, absolutely. You'd expect it to absolutely skyrocket. I mean, it sounds like the perfect storm for a massive market rally.
Right.
It's the kind of quarter management teams literally dream about delivering to Wall Street.
But the market didn't rally.
No, it did not. Not even close.
Instead, Limbach Holdings, the company we are putting under the microscope for today's deep dive, they lost a third of their entire market capitalization in a single afternoon.
Just brutal. A 32% slide.
A brutal 32% slide. So today, we are opening up the books on what I can only describe as a truly bizarre financial paradox.
It really is a paradox, yeah.
We're looking at this 125-year-old company, ticker symbol LMB, that suddenly finds itself at the absolute bleeding edge of modern technology infrastructure.
Which is funny, right? A century-old mechanical contractor doing AI.
Exactly. And we're going to figure out how a business can seemingly do, everything right on the macro level, secure a mountain of future revenue, and still trigger this massive algorithmic panic.
Because that's what it was, a total panic.
Yeah. Right. So if you are an investor looking at LMB right now, you are trying to answer one fundamental question. Is this a falling knife you need to avoid? Or are you looking at a generational entry point into a completely misunderstood business?
And, the answer to that question requires us to look way past the surface level panic.
Right, we have to dig deep.
Yeah, because what we are witnessing with Limbach is this violent collision between lagging operational friction.
The messy stuff from the past, basically.
Exactly, the messy realities of the past 80 days. A collision between that friction and their leading strategic momentum, which is the highly visible revenue they have locked in for the next 2 years.
So the market is looking backward, and management is looking forward.
Precisely. The market algorithms scanned the first quarter 2026 data, fixated entirely on the friction, and just hit the sell button.
They just dumped it.
Yeah, dumped it. Meanwhile, management is pointing frantically at the momentum, essentially telling the market, hey, you are entirely missing the bigger picture here.
Okay, so let's unpack that friction versus momentum dynamic. But we really can't do that without first understanding what this company actually does.
Right, the core business.
Right, and more importantly, what they're trying to stop doing.
Yeah.
Because Limbach is in the middle of this massive strategic transformation.
A huge pivot.
For decades, they operated as a traditional legacy subcontractor. The industry term for this is relying on general contractor relationships.
GCR, right.
GCR, exactly. Now, they are abandoning that model. They are aggressively shifting toward owner-direct relationships, or ODR.
And the numbers from the first quarter really show this pivot isn't just some theoretical idea.
No, it's happening right now.
It is. ODR accounted for an impressive 71.9% of their total revenue.
Wow.
Yeah, that is almost $100 million in a single quarter, strictly from direct-to-owner work.
So the legacy GCR side shrank down to what, 28%?
28.1%, yeah.
Okay, so that structural shift is really the entire thesis of the business right now.
It absolutely is. And to understand why a company would walk away from decades of established general contractor relationships, you have to look at the mechanics of how traditional commercial construction actually works.
Right, let's break that down for people who aren't on construction sites every day.
Sure. So in the GCR model, you are just a subcontractor. Let's say a big developer wants to build a 50-story office tower.
Okay, a huge project.
Huge. They hire a massive general contractor to oversee the whole thing. That general contractor then turns around and puts the mechanical, electrical, and plumbing work out for bid.
The MEPC work.
Right, MEPC. So Limbach historically would bid on that work. But the problem is it's a highly commoditized bidding war.
Because everyone is just looking at the bottom line.
Exactly. You are competing against 5 other firms, and the general contractor almost always picks the absolute lowest price.
So it is a race to the bottom before you even step foot on the job site.
Yep.
You are locking yourself into these razor-thin profit margins on day one.
And those razor-thin margins have to survive incredible execution risk.
What do you mean by that? Like, what goes wrong?
Well, when you are a sub on a massive build, you are entirely at the mercy of the general contractor's schedule.
Ah, right.
And you're at the mercy of the competence of every other trade on the site. If the steel union goes on strike, or say the country guys pour a foundation incorrectly.
Which happens all the time.
All the time. And it delays the project by 3 months. Well, your crews are just standing around. You still have to pay your foreman. You still have your expensive equipment rented, but you cannot do your work.
So you're just bleeding cash.
Exactly. The delays eat your tiny profit margin alive. By the time you actually get in there to install the ventilation system, you might be actively losing money on the job.
Man. So the structural reality of GCR is that you take on an asymmetrical amount of risk for a very small reward.
You are at the absolute bottom of the food chain.
Okay, so how does moving to owner-direct relationships, the ODR model,
Right.
how does that change that dynamic?
Well, ODR bypasses the general contractor entirely. Instead of bidding on new construction, you are contracting directly with the facility owner.
Like the actual hospital administrator or the corporate board?
Yes. You contract with them to service, maintain, and upgrade their existing infrastructure. You are no longer one of 50 disposable trades on a chaotic, muddy job site.
You become an embedded partner.
Exactly. And this work carries significantly higher margins, but crucially, it provides recurring revenue.
Because things always break.
Right. You sign multi-year maintenance contracts. You become the first phone call when a system breaks down in the middle of the night.
I like to think about it like the difference between being a freelance gig worker and an indispensable salaried employee.
That's a great analogy, actually.
Right. Like in the GCR model, you are a freelancer fighting on a job board for the lowest paying gigs, never knowing when the next paycheck is coming.
Yep. Completely feast or famine.
But in the ODR model, you are the in-house IT wizard who knows where all the skeletons are buried in the server room. The company can't fire you because you are literally the only one who knows how the legacy systems actually work. You have job security and you command a premium salary.
That indispensability is the key to this whole pivot. And Limbach isn't targeting just any facility owners.
Where they aren't fixing the AC at the local mall.
No. They are hyper-focused on what they call mission-critical verticals. They have narrowed their entire business down to 6 core markets.
Which are what? Healthcare, industrial?
Healthcare, industrial, data centers, life sciences, higher education, and cultural or entertainment venues.
Okay, and what's the unifying thread there?
The unifying characteristic of all 6 of these verticals is a concept the industry calls zero tolerance for downtime.
Zero tolerance for downtime.
Yeah.
Let's ground that concept in reality for a second.
Yeah.
What does that actually look like for the systems Limbach installs?
Well, if the air conditioning goes out in a suburban strip mall, it is uncomfortable.
Yeah, people complain, maybe leave.
The store owner might lose a few customers that afternoon, but it is ultimately just an inconvenience. Now take that exact same air conditioning failure and put it inside an acute care hospital.
Oh, wow. Yeah.
Right. If the HVAC system regulating the air pressure at the temperature in an operating room fails, surgeries must be halted immediately.
Because of infection risk.
Exactly. Airborne pathogens cannot be controlled without that positive pressure. Human lives are actively at risk. The hospital faces massive liability, reputational damage, and just horrific operational consequences.
Or, take the data center vertical. A hyperscale data center, these massive warehouse-sized facilities operated by the giant tech companies powering AI.
Right, the Googles and Amazons of the world.
Exactly. They draw an unfathomable amount of electricity.
Yeah.
And all of that power generates intense, concentrated heat.
Massive amounts of heat.
Right. So if the cooling infrastructure fails in a data center, the servers don't just politely shut down and save your work.
No, the hardware can literally melt.
Exactly. A thermal event can destroy millions of dollars of advanced microchips in a matter of minutes. It could take critical software platforms offline globally.
And because the stakes are existential for these clients, they do not care about finding the absolute cheapest vendor.
They just want it to work.
They care about certainty. They want a single source lifecycle provider. They want a firm that can engineer the system, build the components, install the machinery, monitor the sensors remotely 24 hours a day.
And have a guy in a truck ready to go.
And have a technician on site at 3 in the morning if a pressure valve drops by 2%.
That's a huge level of trust.
It is. Limbach gathers operational data on these specific, idiosyncratic facility systems over years of maintenance. Now, that institutional knowledge creates a massive competitive moat.
I mean, if I am a hospital administrator, the perceived risk of firing Limbach just to save, what, 5% on a maintenance contract with a cheaper, untested competitor?
It's simply too high.
Right. The switching costs aren't just financial. They are operational and potentially catastrophic.
That is the beauty of the ODR model. Once you establish trust in a zero downtime environment, your revenue stream becomes incredibly sticky.
Okay, so the theory sounds bulletproof. It makes perfect sense why management is aggressively steering the ship toward owner-direct relationships.
On paper, it's brilliant.
But if you are listening to this deep dive right now and you're looking at your portfolio, you are probably asking a very simple question.
Which is?
If ODR is the golden goose, and demand for mission-critical services is supposedly so robust, why did the actual earnings report show that organic ODR revenue declined by 5.4% this quarter?
Right. That is the exact metric that triggered the algorithmic sell-off.
It's a scary number.
It is. The software scanned the earnings release, saw a negative sign next to the core growth engine, and immediately dumped the stock.
Boom. Oh.
But human analysts have to look under the hood.
Yeah.
Yes, the organic ODR revenue, which is the revenue generated by the businesses Limbach has owned for more than a year, did drop by 5.4%.
Okay, but
However, the total ODR revenue actually grew by 10.4%.
wait, I want to make sure the math is clear for the listener.
Yeah.
How do you have an organic decline but a total growth? Like, where did the new money come from?
The absolute growth was completely driven by inorganic means. Specifically, their recent acquisition of a company called Pioneer Power.
Wow, okay.
Pioneer Power contributed over $14 million in ODR revenue for the quarter. That masked the internal organic shrinking.
But the shrinking itself still happened, so what's the story there?
Right, the shrinking requires context. Management was pressed on this exact issue by analysts, and they explained it as a function of timing.
Timing of what?
It was tied directly to when specific maintenance contracts closed and how quickly they burned through the existing backlog of projects in the early months of the year.
Meaning the work is still there, it just didn't hit the billing cycle during January, February, or March.
Exactly. Furthermore, they are still fighting the ghost of macroeconomic headwinds from the previous year.
What happened last year?
Well, in the middle of 2025, there were significant changes to healthcare policy in Washington, D.C.
Okay, policy changes.
Combined with the threat of a late-year government shutdown.
Oh, right, when everything kind of froze.
Exactly. When federal funding becomes uncertain, massive hospital networks do not authorize major capital expenditures.
They tightened the belt.
They freeze their budgets, they delay the HVAC upgrades. The lower bookings from the summer and fall of 2025 are finally echoing through the income statement in the first quarter of 2026.
Oh, I see. So the organic decline isn't a signal that the ODR strategy is fundamentally failing.
No.
It is a delayed reaction to a budget freeze that happened 6 months ago.
That is management's perspective, yes. It is a lagging indicator.
A lagging indicator. Okay, this sets up the tension perfectly.
It really does.
Because the business model transformation makes logical sense, but the short-term financial realities of the first quarter are just incredibly messy.
Messy is putting it mildly.
Right. Let's dig into the numbers that truly terrified the market. The reports show what analysts actually called an EBITDA plunge.
Yeah, that's a dramatic phrase.
Adjusted EBITDA dropped 41.7% year over year, landing at $8.7 million.
We should probably define EBITDA clearly for anyone who isn't staring at financial statements all day.
Yeah, good idea.
It stands for earnings before interest, taxes, depreciation, and amortization.
Mouthful.
It is. But it is essentially the quickest way to measure a company's raw operational cash profitability before the accountants start applying complex tax structures or depreciating the value of their trucks.
Right, it's the raw engine power.
Exactly. So a 41% drop in raw operational profitability is a severe blow.
And it wasn't just the overall profit that fell. The margins collapsed as well, didn't they?
It did.
Consolidated gross margins compressed by 520 basis points, falling from 27.6% down to 22.4%.
Basis points are just a granular way the financial industry talks about percentages. 100 basis points equals 1%.
Okay.
So a 520 basis point drop means they lost 5.2% of their gross profit margin.
Which is huge.
Massive. For a company operating in the mid-20s, losing 5% of your margin is a massive erosion of pricing power and efficiency.
And then add to that the fact that total organic revenue across the entire company, combining both ODR and the legacy GCR work, declined by 13.4%.
Right.
Which represents nearly an $18 million drop.
It's a lot already.
You look at those three numbers, cratering EBITDA, collapsing margins, and shrinking organic revenue, and honestly, that 32% stock slide begins to seem entirely rational.
Oh, if you stop reading the report right there, it is completely rational.
Right.
But on the exact same day, in the exact same filing, Limbach announced total bookings of a record $209.1 million.
Wait, record bookings.
Yes, they posted a 1.5 times book-to-bill ratio.
Let's translate book-to-bill. It simply means for every single dollar of revenue they billed to clients and recognized in the quarter, they signed contracts for $1.50 of new future work.
Right. They are filling the pipeline 50% faster than they are draining it.
That's a staggering contradiction.
This is where we have to separate that trailing friction from the forward momentum. That 13% organic revenue decline tells you what happened in the past.
Right, the lagging stuff. We already discussed the delayed healthcare budgets. But were there other reasons for that revenue drop?
Yes, there are two other massive drivers for that decline that show it is actually a healthy, intentional process.
Okay, what else drove the revenue down besides the hospital delays?
Normal industrial seasonality is a major factor.
Seasonality, like winter versus summer.
Kind of. A significant portion of Limbach's direct-to-owner work is in heavy industrial and manufacturing facilities. Those massive corporate clients typically finalize their annual maintenance and upgrade budgets in the first quarter. They don't actually unlock the spending and allow contractors on site until April or May.
Oh, I see. So the first quarter is just inherently slow for them.
Historically, the first quarter is always the slowest period for the industrial vertical. But the third driver, this is the most important one.
Okay, what is it?
It's Limbach's own intentional discipline.
You are talking about them actively walking away from the legacy GCR contracts.
Precisely. They are deliberately letting that 28% of their business shrink.
Just letting it wither.
Yeah. When a general contractor calls them to bid on a massive new high-rise project, management is looking at the low margins, evaluating the execution risk we discussed earlier, and they are simply declining to bid.
No thanks.
Exactly. So a significant portion of that revenue decline is entirely self-inflicted. It is a necessary amputation of a low-margin limb to improve the health of the overall organism.
Okay, so the revenue decline is a combination of seasonal delays, the ghost of 2025 politics, and an intentional pruning of bad business.
Right. That's the backward-looking view.
Contrast that past-looking data with the leading indicator. The $209 million in fresh bookings is entirely new demand.
Fresh contracts.
And when you combine that with the numbers from the fourth quarter of 2025, Limbach has secured over $434 million in total backlog over a 6-month period.
It's incredible.
That is almost $500 million of future revenue sitting on the books waiting to be executed.
And it provides unprecedented visibility into their future cash flows. Very few companies in the construction or facility services sector have that level of guaranteed demand locked in.
But the market algorithms couldn't see past the margin compression.
They never do. They just see the 5% drop and react.
So to determine if the market overreacted, we have to deconstruct exactly where that 5.2% of profitability went.
Right. Let's dig into the margin erosion, because the financial disclosures provide a very granular breakdown of it.
Okay, the drop went from 27.6% down to 22.4%. Where did the first half go?
Exactly half of that drop, so 2.6 percentage points, came directly from the dilutive impact of acquiring Pioneer Power.
The company they bought.
Right. Pioneer operates at a significantly lower margin profile than Limbach's core business.
Okay.
When you consolidate their financials and layer Pioneer's $23.5 million of revenue into the mix, it mathematically drags the corporate average down.
It dilutes the pool.
Exactly. Management explicitly pointed out that if you remove the Pioneer acquisition from the spreadsheet entirely, the organic gross margin was a much healthier 25.0%.
Okay, so half the problem is just a mathematical quirk of buying a lower margin company.
Basically, yes.
But that still leaves another 2.6% drop in the core organic business. Dropping from 27.6 to 25 is still a meaningful hit to profitability.
It is. The remaining erosion was driven by a lack of positive project write-ups compared to the prior year, and a severe problem with what accountants call fixed cost absorption.
Fixed cost absorption. That is a notoriously dry accounting concept.
It really is, yeah.
But it is the secret engine behind why the profits collapsed in Q1. I like to think of it like operating a commercial airline.
Oh, that's a good way to explain it.
Right. So the cost to fly a 737 from New York to Los Angeles is largely fixed.
Yeah.
You have to pay the pilots, you have to pay for the jet fuel, and you have to pay the leasing fee on the aircraft regardless of how many people are actually sitting in the cabin.
The plane costs what the plane costs.
Exactly. If you fly the plane with only 10 passengers, because it is the slow season, the revenue from those 10 tickets has to absorb the massive fixed cost of the entire flight.
Which means the per-ticket profit margin looks horrific.
Right. But if you pack the plane with 200 passengers, the exact same fixed cost is spread out efficiently. The flight becomes wildly profitable.
And that dynamic is exactly what punished Limbach in the first quarter.
How so?
Well, the reports show that Limbach actively increased their fixed operating costs in anticipation of future growth.
What did they buy?
They bought more service vehicles, their commercial insurance premiums went up, they invested heavily in new tools, supplies, and corporate safety programs.
So they essentially leased a larger fleet of 737s.
Exactly. But because organic revenue was seasonally low and down 13%, those higher fixed costs ate up a drastically larger percentage of their gross profit.
The denominator shrank while the numerator grew.
Precisely. They flew a larger plane with fewer passengers. The fixed costs weren't absorbed efficiently by the low revenue base.
Okay, I get it. But here is the critical takeaway for me. When you read the transcripts from the earnings call, the management team is remarkably calm.
Very composed, yeah.
They aren't announcing emergency layoffs or slashing the vehicle fleet to cut costs.
And they aren't panicking because they know the massive $434 million backlog is sitting right there.
It's waiting to board the plane.
Right. They know that when those contracts transition into active projects and revenue floods the income statement in the second half of the year, it will organically solve the absorption issue.
The planes will be packed.
The planes will be packed, the fixed costs will be spread out across a much larger revenue base, and the gross margins will mathematically snap back to historic levels.
So that leads to the most important question for anyone evaluating this stock. What exactly is filling up that massive backlog?
Right. Where is it coming from?
Where is this unprecedented demand coming from? And the answer brings us to the most explosive sector in the global economy right now.
Data centers.
And the primary reason Limbach might be drastically undervalued: artificial intelligence and data centers.
The structural shift happening in the data center vertical is honestly the most compelling aspect of the entire Limbach narrative.
The numbers are just staggering. According to the Q1 data centers accounted for approximately 27% of the entire $209 million bookings figure.
Which is huge.
That is over $56 million secured in a single vertical in just 90 days.
Yeah.
And to handle this influx, Limbach announced they are actively adding specialized national resources to their data center team in the first half of 2026.
And it is crucial to understand here that Limbach is not just a tourist chasing the latest artificial intelligence hype.
Right. They didn't just add AI to their press release.
No, they didn't just rebrand themselves to boost their stock price. They have been engineering and building infrastructure for massive hyperscalers, the global tech giants that run the internet for over 10 years.
They've been in the trenches.
They have. What management emphasized on the call is that their capability hasn't changed, but the absolute scale and urgency of the demand from these hyperscalers has wildly accelerated.
But this acceleration creates a fascinating contradiction in Limbach's overall strategy.
How so?
Well, we just spent 20 minutes discussing how Limbach is actively running away from general contractor relationships, GCR, because they are low margin and highly risky.
Right, they hate GCR.
Yet, management explicitly stated they will selectively pursue high-quality GCR opportunities. specifically in the data center vertical.
Ah, yes.
Why abandon their core philosophy just for this one sector?
Because the risk-reward calculus in the artificial intelligence build-out is totally distorted compared to traditional commercial construction.
The rules are different here.
Very different. Yes, Limbach's overarching goal is to work directly with facility owners. But when a brand-name global tech company announces they are spending $3 billion to build a massive AI campus in Ohio,
Yeah.
they are going to hire a massive national general contractor to manage the logistics of a site that big.
Right. They need a middleman for a project that size.
Exactly. And if that general contractor comes to Limbach and says, hey, the tech giant specifically requested your firm to handle the mission-critical cooling systems.
Oh, they asked them by name.
You do not walk away from a $40 million high-margin contract simply because of the structural relationship.
You hold your nose, sign the GCR paperwork, and take the money.
You take the work, absolutely, but you vet it ruthlessly.
What do you mean by vet it?
Management stress that they are maintaining extreme discipline. They are strictly evaluating the risk profile of the general contractor.
Making sure they aren't going to screw up the project.
Right. Ensuring their operational philosophies align and guaranteeing that the risk-adjusted returns justify the deviation from their ODR focus. They are capitalizing on a generational infrastructure build-out where their specific expertise gives them a highly differentiated right to win the bid.
Okay, so let's talk about what that specific expertise actually entails. Because when the average person hears about the AI boom, they picture NVIDIA microchips, massive server racks, and software engineers writing complex algorithms.
Right. Code and silicon.
Exactly. What is a century-old mechanical contractor actually doing inside these pristine technological temples? They aren't plugging in Ethernet cables, right?
No, they're building the industrial life support systems that prevent the technology from destroying itself.
The life support?
Think about the thermal dynamics of artificial intelligence. Traditional cloud computing servers generate heat, sure, but AI workloads require specialized, high-density processors that draw massive amounts of power.
Because they're doing so much more math.
Exactly. A single rack of AI servers can generate 10 to 20 times more heat than a standard server rack.
Wow. It is essentially a warehouse filled with tens of thousands of industrial space heaters running at maximum capacity simultaneously.
That's exactly what it is. And if you do not remove that heat constantly, precisely, and flawlessly, the hardware fails within minutes.
So Limbach builds the complex mechanical infrastructure to remove that heat.
Yes. They install massive chilled water loops, utilizing industrial-grade pipes welded to exact specifications.
Heavy industry stuff.
They install massive air handlers that circulate millions of cubic feet of cooled air. They build the structural steel platforms required to hold the immense weight of these cooling towers.
Wow.
And they wire the incredibly complex sensor systems that monitor the temperature and humidity of the server floor down to a fraction of a degree.
So they are bending the physical steel and welding the industrial pipes that keep the digital revolution from melting down.
That's a great way to put it, yeah.
And the hyperscalers need these systems built at a pace the construction industry has just never seen before.
The speed is insane.
Right. Traditional institutional work, like building a university science lab, is heavily backloaded. The university plans the budget for years, breaks ground, and the money slowly trickles out over a 36-month timeline.
A very slow burn.
But data centers operate on an entirely different plane of reality. The timeline for conversion is incredibly aggressive.
They want it done yesterday.
The tech companies are demanding what they call speed to market. Management noted that these data center projects are rapid burn, and that velocity is going to fundamentally smooth the seasonal curve for Limbach's revenue in 2026.
And that velocity is a critical point for investors to digest. When a hyperscaler decides to build a data center to train a new large language model, they cannot wait 3 years.
No way.
Every single day a processor isn't crunching data, the tech company is losing millions of dollars in potential revenue and falling behind their competitors.
The AI arms race.
Exactly. They exert immense pressure on their supply chain to move at light speed. This means the $56 million in data center bookings Limbach secured in Q1 are not going to sit dormant in the backlog for 2 years.
They aren't just theoretical numbers.
No, those contracts are going to start converting into recognized revenue and cash flow in a matter of months.
But wait, there is a physical limit to speed. You cannot just throw 200 guys with wrenches into a muddy field and expect them to build a highly complex, mission-critical chilled water system in 3 months.
No, that would be a disaster.
Traditional on-site construction is inherently slow, dangerous, and vulnerable to weather delays. So how is Limbach physically meeting this insane speed-to-market demand?
By completely changing how they build. They are abandoning the traditional on-site construction model and embracing modular prefabrication.
Modular prefabrication.
Yes. This is where physical scale becomes a massive, insurmountable competitive advantage for them.
So the reports detail that Limbach is leveraging a massive 14-acre fabrication facility to meet this demand.
14 acres under a roof, yeah.
They acquired this specific capability when they brought a company called Jake Marshall back in 2021. And this sheer physical capacity just helped them win a major contract.
A huge one.
They were awarded a project worth over $30 million for a hyperscaler that encompasses massive steel structures and complex piping systems.
Right. And to understand why a 14-acre facility wins a $30 million contract, you have to compare it to the alternative.
Okay, what's the alternative?
Historically, you ship thousands of individual raw steel beams, unbent pipes, and thousands of separate fittings to the construction site.
Sounds chaotic.
It is. Then, dozens of tradesmen trip over each other, trying to weld it all together in the rain, the wind, and the dirt.
Oh, man.
Quality control is a complete nightmare, and the pace is agonizingly slow.
So if the hyperscaler is demanding the facility be operational in 6 months, that traditional method is just a non-starter.
Precisely. It won't work. So what Limbach does is prefabricate massive sections of the infrastructure off-site.
In that 14-acre facility.
Inside their controlled, indoor 14-acre factory environment, they build complex piping assemblies. They weld together multi-ton structural steel skids.
Nice and clean.
They build entire mechanical modules complete with pumps, valves, and sensors. They do all of this in a clean, safe, highly controlled environment where quality can be rigorously checked.
And then what?
Then they load these massive finished components onto flatbed trucks, drive them to the data center site, and essentially snap them together using cranes.
I think of it like building a massive complex Lego set.
Exactly like Lego.
The traditional method is trying to find all the individual pieces and assemble them in a crowded, messy living room where people are constantly walking by and tripping over you. But Limbach's method is building massive pre-assembled chunks of the Lego set in a giant, organized warehouse, bringing those huge chunks into the living room and just clicking the large sections together in an afternoon. Speed is everything.
And that speed translates directly into financial performance.
How so?
Well, management highlighted that the $30 million hyperscaler project is going to be a very quick burn. They expect it to generate recognized revenue over the next few quarters.
Oh, it's fast money.
It is an immediate, powerful catalyst for the income statement.
Let's connect the dots back to the friction we discussed earlier. That rapid execution is the exact mechanism needed to drive the revenue acceleration in the second half of 2026.
Yes, it is.
It is the exact cure for the fixed cost absorption problem. The faster they burn through that $30 million, the faster they pack the 737 with passengers, and the faster those fixed costs are efficiently absorbed.
And if you zoom out to look at the broader competitive landscape, this 14-acre facility is no longer just a logistical advantage.
What is it then?
It has evolved into their primary sales tool.
Oh, really?
Management explicitly noted that while their competitors are completely backed up, struggling with severe labor shortages, or failing to manage chaotic on-site builds.
Limbach has excess fabrication capacity.
Yes, they literally bring the executive teams from these global tech giants on physical tours through the 14-acre facility.
Wow, they show it off.
They walk them down the shop floor, point to the machinery and say, we have the physical space, the specialized tools, and the highly trained manpower sitting right here, ready to deliver your cooling system months faster than anyone else bidding on this project.
Seeing the massive physical infrastructure with their own eyes removes the perceived risk for the tech executives.
It is the ultimate proof of capability. It is exactly why Limbach can capture 27% of their total bookings from data centers in a single quarter.
They are selling speed, but more importantly, they are selling certainty. Okay, so the strategy is brilliant. The backlog is massive. The technological tailwinds are generational. But we have to address the massive elephant in the room.
We do. The cash problem.
We have to address the fear that drove the algorithms to wipe out a third of the company's value.
Yeah.
If business is this incredibly robust, Why is the company actively bleeding cash right now?
It's the million-dollar question.
This leads us to the critical issue of capital allocation, liquidity, and what Wall Street analysts call acquisition indigestion.
This is where we have to leave the exciting narrative of AI data centers and look coldly at the cash flow statement, because this is where the bears are finding all their ammunition.
Okay, let's lay out the bad news.
Yeah.
The financial disclosures reveal that the first quarter saw a $7.8 million net operating cash outflow.
Yep.
The company burned almost $8 million in 90 days. Compare that to the exact same quarter last year, where they generated a $2.2 million cash inflow.
That is a brutal swing.
A negative $10 million swing in
Yeah.
liquidity. The sources detail the specific drivers of this cash drain. Lower net income, which we discussed. Millions spent on prepaid commercial insurance premiums. Large incentive compensation payouts to management and staff.
Right.
And crucially, massive contingent earn-out payouts for prior acquisitions, specifically the companies Kent Island and Industrial Air.
We really have to unpack those components meticulously,
Right.
because a cash outflow always terrifies retail investors. But not all cash outflows are created equal.
Okay, break it down for me.
Well, the lower net income and the heavy prepaid insurance premiums, those are just standard operational friction points in a seasonally slow quarter.
Annoying, but normal.
Right. The incentive compensation, and they also burned $5.8 million in cash to pay employee taxes related to stock withholding.
Oh, I missed that. So $5.8 million just for taxes.
Yeah. But those are essentially balance sheet mechanics. They are rewarding employees and settling tax liabilities, which is normal corporate behavior, even though it hurts immediate liquidity.
What about the contingent earnouts? Why is a company burning millions of dollars, paying for companies they already bought years ago?
This is a vital piece of the mergers and acquisitions puzzle.
Okay.
In the commercial construction and services sector, when a larger firm like Limbach buys a regional company like Kent Island or Industrial Air,
Yeah?
they rarely hand over a briefcase full of cash for the entire purchase price and just walk away. The risk is too high.
Because the owners might just leave.
Exactly. The acquired company's leadership might take the money and retire to Florida, and the business could collapse. So they structure the deal using earnouts.
Explain the mechanism of an earnout. How does it protect the buyer?
The buyer provides a smaller portion of the purchase price up front. The remainder of the agreed-upon value is contingent.
Based on performance.
Right. The sellers only get the rest of their money if the acquired business hits very specific, aggressive financial growth targets over the next 2, 3, or 4 years.
Okay, so it aligns the incentives. The acquired management team has to stay on board and hustle to hit those targets to get their full payout.
Exactly.
So, if Limbach is bleeding millions of dollars in cash right now to pay these earnouts for Kent Island and Industrial Air.
It means Kent Island and Industrial Air crushed their financial targets.
Oh.
It means the businesses they acquired are highly profitable and growing exactly as planned. Yes, paying the earnout drains cash today, but it is the ultimate proof that Limbach's M&A strategy is actually working.
So a good thing.
It is a highly bullish signal disguised as a negative cash flow metric.
Wow, okay. I understand the logic there. The past acquisitions are performing. But that brings us to the current integration nightmare, Pioneer Power.
Pioneer, yeah.
Limbach acquired Pioneer in July of 2025 for roughly $66 million. As we discussed, Pioneer added $23.5 million in revenue this quarter, but it was highly dilutive, single-handedly dragging the corporate gross margins down by 2.6%.
It's a heavy drag.
And management openly admits it is going to take a grueling 2 to 3 year margin recovery plan to bring Pioneer's profitability up to the corporate average.
The Pioneer integration is the anchor currently weighing down the entire financial profile of the company. It is a massive digestion process.
And despite this massive digestion process actively dragging down profitability and burning cash, management announced they plan to execute 1 to 3 additional acquisitions before the end of 2026.
Right, they want to buy more.
Here is where the market's skepticism hits an absolute fever pitch.
Understandably so.
I mean, put yourself in their shoes. You are the management team?
Yeah.
You just told me it is going to take 3 years to fix the margins of the company you bought last summer.
Yep.
You are actively burning millions in operating cash.
Yeah.
Your raw profitability just plummeted 41%, and your grand solution is to go buy up to 3 more companies this year.
It sounds wild.
That sounds reckless. It sounds like trying to eat a massive second Thanksgiving dinner while you are actively choking on the first one.
That is a totally valid fear, and it is the exact psychological mechanism that drove the 32% stock drop.
Acquisition indigestion.
Exactly. The market is terrified of acquisition indigestion. Institutional investors fear that management is addicted to buying top-line revenue growth to mask organic weakness, and they are willing to destroy the company's gross margins in the process.
Just buying growth at any cost.
Right. However, if you ignore the fear and look at the specific mechanical steps management laid out for the Pioneer turnaround plan, there is a clear, methodical logic at play.
Okay, so how do you mechanically fix a $66 million company that is dragging down your margins? You can't just wave a magic wand and make them more profitable.
No, you utilize specific operational levers. First, management noted that the entire first year of the Pioneer acquisition was focused exclusively on integrating the boring back-end systems.
The paperwork.
Right. They had to transition Pioneer onto Limbach's corporate accounting software, integrate their safety protocols, and merge their payroll systems.
So that takes time.
That heavy administrative lifting is now complete. The focus is now strictly on extracting gross profit.
Okay, how?
The primary lever is reviewing and renegotiating Pioneer's legacy contracts. Pioneer had contracts on the book that were priced way too low for the current inflationary environment.
And they were losing money on old deals.
Essentially, yes. Limbach's management is going to those clients and demanding better pricing, or they were just walking away from the work when the contract expires.
Pruning again.
Right. They are actively optimizing the project mix, ensuring Pioneer only takes on high-margin, complex work going forward. But the most powerful lever of all is cross-selling.
You mean routing the high-margin data center work through Pioneer's operations?
Exactly. Pioneer is geographically located in the upper Midwest,
Okay.
which happens to be a massive, rapidly expanding hub for heavy industrial and data center construction.
Location.
Limbach is taking its established, decade-long relationships with hyperscalers and routing that highly profitable work through Pioneer's regional footprint.
Oh, that's smart.
We actually saw the immediate results of this strategy in the first quarter. Pioneer was awarded a $6 million data center retrofit contract.
Just handed to them.
Well, earned through the parent company, yeah. That specific contract requires rapid execution and contributes immediate high-margin revenue in the second quarter.
So by continuously layering highly profitable mission-critical work on top of Pioneer's legacy industrial base, the overall margins of the subsidiary will mathematically improve over time.
That's the plan.
That makes sense operationally. But practically, how does Limbach pay for 1 to 3 more acquisitions this year if they just burned $8 million in cash? Do they even have the money?
They absolutely have the money because their overall corporate liquidity remains incredibly strong.
Even with the burn?
Despite the Q1 cash burn, the balance sheet is highly durable. The financial disclosures indicate they have $76.4 million in total available liquidity.
Okay, break that liquidity down. Where is that money sitting?
It consists of $15.8 million in actual cash sitting in the bank and $32.4 million available to draw on a $100 million revolving credit facility.
So they have a massive credit line.
Exactly. And against that liquidity, their total outstanding debt is only $57 million.
Okay.
That gives them a net leverage ratio of roughly 0.55 times.
Wow. For context, a leverage ratio under 1.0 is considered extremely conservative, especially for a firm operating in the capital-intensive construction and services sector.
It is. They are not over-leveraged at all.
They have plenty of dry powder to fund these new acquisitions without stressing the company's survival.
The balance sheet is basically a fortress.
But that still leaves the question of why.
Right. Why now?
Why do they need to acquire more companies right now? If the balance sheet is safe and the backlog is massive, why not just pause? Integrate Pioneer over the next 2 years and enjoy the profits from the data center boom. Why take the risk of further indigestion?
Because the hyperscalers are expanding nationally right now, time is the ultimate enemy.
Oh, I see.
Management noted that these massive tech giants want infrastructure partners whose geographic footprint matches their own massive scale.
They want a one-stop shop.
Exactly. If a hyperscaler is simultaneously building multi-billion-dollar campuses in Ohio, Texas, and Virginia, they do not want to manage 3 different regional mechanical contractors.
That sounds like a headache.
They want one unified vendor who can handle all 3 locations with the exact same standard of quality.
So if Limbach does not expand its geographic reach through targeted acquisitions immediately, They risk losing massive market share to larger national competitors who can offer that multi-state capability.
It is a land grab.
A gold rush.
The artificial intelligence infrastructure build-out is happening today, and Limbach has to move fast to plant their flag in key geographic regions.
That makes perfect sense.
Furthermore, regarding the cash burn, management explicitly stated they expect to convert 75% of their full-year EBITDA into free cash flow.
Oh, wow. 75%.
Yes. That target indicates they fully expect the working capital drain from the first quarter to heavily normalize by the end of the year as the massive new bookings convert into actual cash payments.
Okay, so we find ourselves at the ultimate crossroads here.
We do.
A mountain of immediate visible execution risk staring down a mountain of high-margin generational backlog. Let's synthesize all of these conflicting data points and render a final verdict.
Let's do it.
Is the 32% drop a value unlock opportunity, or is it a trap for retail investors?
We really have to look closely at what management is promising versus what the market actually believes.
Let's review the tape. The stock took a 32% slide. As a result, the price-to-earnings ratio is currently sitting at roughly 23.6.
Which is pretty reasonable.
Right. Various financial models suggest the stock might currently be undervalued relative to its fair value. And despite the brutal first quarter and the algorithmic panic, management stepped up to the microphone on the earnings call and completely unequivocally reaffirmed their full-year 2026 financial guidance.
They didn't blink. They didn't lower expectations by a single dollar.
They are projecting $730 million to $760 million in total revenue for the year.
Huge numbers.
They project $90 million to $94 million in adjusted EBITDA. And crucially, they are projecting a 26 to 27% gross margin for the full year.
And that margin guidance is the battlefield. That is where the war between the bulls and the bears will be fought.
Why is that?
Think about the math required to achieve that. Limbach ended the first quarter with a dismal 22.4% gross margin.
Right.
To drag the annual average up to 26 or 27%, they have to perform exceptionally historically well in the second half of 2026.
They have to overcompensate.
They will need to string together quarters operating near 28 or 29% just to pull the mathematical average up for the year.
Wow.
The market looked at that required trajectory and simply said, "We do not believe you can execute that flawlessly."
But based on everything we have unpacked today, is it mathematically possible for them to hit those numbers?
It is entirely mathematically possible. And the financial disclosures actually outline 4 specific mechanisms that will drive that margin expansion.
Okay, let's hear them.
First, the organic base, so the core business, excluding Pioneer, is already operating at 25%. They do not need a miracle turnaround there. They only need to find a few basis points of efficiency improvement on the core business.
Okay, that's one.
Yeah.
Second, the record $209 million in bookings will flood the income statement in the second half of the year.
Yes.
That massive surge in recognized revenue will completely cure the fixed cost absorption drag. The 737 plane gets packed with passengers, and the fixed costs become negligible on a percentage basis.
Exactly. Third, the rapid burn data center work, which inherently carries exceptionally high margins due to its complexity and speed requirements, will act as a powerful upward force on total corporate profitability.
It pulls the average up.
Right.
And fourth, the highly profitable owner-direct relationship segment, which experienced that slight timing-related dip in Q1, is expected to normalize and climb back to its target range of 75 to 80% of total corporate revenue.
So when you combine those 4 factors, the path to a 27% gross margin is actually incredibly clear.
If you are an investor trying to make a decision, there are really 2 distinct ways to view this company right now. Let's summarize the bear case first.
Sure. From the perspective of execution risk, the bear case is that the margin compression is real, and it is a massive warning sign.
They don't believe the turnaround story.
Right. The bears believe that integrating complex acquisitions like Pioneer always takes more time, costs more money, and causes more operational disruption than management ever admits publicly.
Which, to be fair, is historically often true.
It is. Furthermore, the sudden, violent cash drain in the first quarter proves that the operational friction of pivoting away from GCR is heavier than anticipated.
So from the bear perspective, the 32% drop wasn't an algorithmic mistake. It was a necessary, healthy re-rating of a company that flew too close to the sun and stumbled on execution.
That's the bear case in a nutshell.
But then you have the bull case, the value unlock perspective. In this view, the first quarter was merely a transitional lagging anomaly.
Just a blip.
Right. The weak numbers were an echo of macroeconomic delays from 2025 and the mathematical quirk of absorbing a new acquisition.
Exactly. The true value of the company lies in the massive $434 million two-quarter backlog, which represents a generational demand signal.
The demand is there.
The data center surge is real, it is accelerating, and Limbach possesses the unique 14-acre fabrication capacity to capture it.
Therefore, from the bull perspective, the post-slide valuation isn't a warning sign to flee. It is an incredibly attractive entry point for investors who have the patience and the stomach to ride out a few months of acquisition integration while the backlog converts to cash.
So it all comes down to execution.
So, what is the ultimate takeaway for the listener staring at this ticker symbol? Is this a classic show-me story where the smart play is to sit on the sidelines, protect your capital, and wait for the Q3 earnings report to see if management is actually telling the truth?
Or is the 32% discount the actual fleeting opportunity that you have to grab right now before the market realizes its mistake?
Right. What's the verdict?
It is the absolute definition of a show-me story, but it is a uniquely de-risked one because of the unprecedented revenue visibility.
Explain that.
Usually when a company misses earnings and tells investors, hey, trust us, things will get much better in the second half of the year, they are relying on hope.
Yeah, we hope people buy our product.
Right. They're hoping that consumer demand materializes or hoping that macroeconomic conditions improve. Limbach does not have to rely on hope.
The demand is already there.
The demand is not theoretical. It is already legally contracted and sitting in their backlog. They have the signed agreements. They have the 1.5 times book-to-bill ratio. The revenue is physically there.
So the entire thesis comes down to pure operational execution.
100%.
Can they physically weld the pipes, install the massive cooling chillers, and manage their specialized labor force efficiently enough to extract the profit margin that is inherently embedded in those signed contracts?
That's the only question that matters. The fundamental risk of finding demand is completely gone. Only the granular risk of execution remains.
And that is a much safer profile for an investor than hoping demand materializes out of thin air.
It is a huge distinction.
Think about the broader artificial intelligence revolution for a second. Every single day on the financial networks, everyone is breathlessly chasing the shiny microchip companies, the software developers, the massive tech giants building the large language model.
The NVIDIAs of the world.
Right? The valuations for those companies are astronomical, priced for decades of absolute perfection. But none of that technology exists in a vacuum.
It requires hardware, physical hardware.
Not a single line of advanced AI code can be processed. Not a single neural network can be trained without the physical mission-critical infrastructure required to cool it, to power it, and to protect it from literally melting down.
It is the classic picks and shovels play during a gold rush.
Exactly.
Historically, the companies providing the unglamorous foundational infrastructure often end up generating the most reliable long-term returns, while the prospectors take all the risk.
Is the real sustainable wealth in the artificial intelligence boom going to be made entirely by the software coders in Silicon Valley?
Probably not all of it, no.
Or is a massive portion of it going to flow to the boring companies, bending structural steel, running complex chilled water pipes, and operating 14-acre fabrication yards in the Midwest?
It really makes you look at a 125-year-old mechanical contractor in a completely new light.
It really does. Thank you for joining us on this deep dive. We encourage you to keep looking beneath the surface of the market, look beyond the immediate panic of the algorithms, and find where the real, physical, foundational shifts in the global economy are actually happening. Risk defined, portfolio protected.